Hello and welcome back to another episode of Fun Friday with a very special guest today, a friend and partner with the firm, the president of president of Invest Arc Properties, Randy Langenderfer. How are you today?
Craig, I'm doing great. Thanks so much for the opportunity to be on the show. It's a real privilege.
Yeah, well, and I apologize. We were kind of joking, going back and forth about getting your title correct going on. So just for the record, did I get your title okay? Did I put the respect in your name? Please let me know if I butchered it, because I felt a little bit. I think I talked about it so much I psyched myself out here.
I think you did too, and you did fine. Randy Langenderfer for Invest Arc Properties. Just don't call me late for dinner is all I ask.
Very good, very good. Well, thank you so much for coming on the show today. I feel very lucky as well to have you on here. Would love just to know a bit about yourself, your story, how you got into real estate. But before that, what did you do before getting into real estate?
Well, Craig, you may or may not recall. So I've been in real estate about 10 years, maybe 12. Started out in single family, but long-term corporate guy, an executive that recently just stepped away from the corporate world just about a year ago, at the end of April in 23, to do real estate full time. And I'm having a lot of fun with it. I still work hard, but I'm working for myself versus working for the man, as I call it, and that's pleasurable.
Right, that's awesome. And what field of work were you in prior? Were you, if I'm not mistaken, Baylor potentially?
I was at Baylor College of Medicine. I'm located in Houston, Texas today, and I was the chief privacy compliance audit officer and did cybersecurity for the Baylor College. I was the executive responsible for all that crap that nobody else wanted to do, and it was good. I enjoyed it, and like I coach a lot of people, and I just say, make sure you have enough wherewithal to step away and do this full time. I was blessed, and I really didn't want to step away and have an income of $25,000. So I waited till the opportunity was right and had a portfolio built up and et cetera, et cetera.
Yeah, it's awesome. Well, it's always smart to have the next plan and, way to go prior to needing to know it and being forced, have that being forced upon you naturally, right? So would love to learn a little bit more how you got into the real estate space. I mean, it sounds like naturally you needed to figure out, a way to supplement your income and kind of set up yourself for success in the future, and not relying probably just upon the pensions and Social Security, right? So I'd love to learn more about that kind of story.
Yeah, my journey started about a decade ago, Craig. I was living in the Cleveland, Ohio market, and I had a brother-in-law that got me into single family flips. We were hard money lenders, and I was working for a private equity company, Carlyle, very nationally known big group. I was one of their portfolio companies as an exec, and was afraid of getting laid off and seeing my income as a single family earner. With family and kids, I was very afraid of not having an income. And at that season of my life, it was just a real aha moment for me to go, you got to find another source of income. And so I set about a very deliberate course when I came to Houston 10 years ago to really develop that passive income stream, found multifamily, fell in love with it, started investing in other people's deals, became a GP and 18, did my first deal in 18. Fast forward today, I'm in about 1,500 doors as a GP, and I probably got about 3,000 as an LP. So I'm all into this asset class. Let's put it that way.
Yeah, and I'd be very curious to know kind of what the aha moment was to kind of transfer away from the single family space to the multifamily space. Was it just looking at the forced appreciation play to it? What to you made the multifamily space so attractive?
A couple things. Well, one, I was at the season of life where I had a few assets. And when you start buying single families, you sign recourse loans. So not that I was afraid of losing them, but I wasn't going to lose them. But when I realized I could buy a multi-million-dollar apartment building without any personal guarantees, that was an aha moment. The other one was when I realized I could do this starting out while still working. I didn't have to jump into it full time because there's a ton of people out there doing both, working and part time. So I built myself into it gradually, but it was the recourse loan, it was the part time nature, and then lastly, scaling. To scale single families becomes really challenging to get 100 single family houses or even 50 geographically, where multifamily, I team with people, I can have assets in multiple places using third-party property management. And you just get a whole lot better economies of scale.
Yeah, well, and it's kind of interesting too, as time's progressed. I do think the commercial space is a lot more distressed than the single family space. But the interesting thing about the single family space is that there's basically zero cash on cash return right now. If you factor multifamily right now is offering substantially better cash on cash return. And the single family housing market, for the better or worse, is very stable right now, which makes it challenging to make the numbers make sense on the single family side. There's always some development plays you can do to make it make sense, but seemingly
Right.
if you're looking at the landscape of the marketplace, you're dollars in, you're going to get a better cash on cash return in the multifamily space, at least for right now. And things ebb and flow and change, but certainly seems like that is what the market is dictating at the moment.
And it's much easier to be, if you want to be a passive investor, it's much easier to be passive in commercial real estate, i.e. multifamily, than being passive in much more, in my mind, liability on the passive single family side. I was a hard money lender. My last one started and ended up going south. So in my mind, there's more risk to single family hard money lending than passive investing to multifamily, where you're in a large syndication and it's operators are much more sophisticated and there's business processes, et cetera, et cetera.
Yeah, without a doubt. So I would love to hear about your first real estate investment. Was it a home? Was it, the debt side? What did that look like for you? And then I'd love to learn about the first time you, dabbled into the world of multifamily investments.
So I'll take that as a way back when. The first place my wife and I bought before we had kids was a duplex. I had it in my blood way back then. Realized at that juncture that I never wanted to be a landlord again. Got busy with the career and life and raising a family. Came back to it later. My first investment was in multifamily after doing the single family fix and flips. And my first multifamily investment was with a guy that I had met who, the old cliche that I know, liked, and trust. Met him at a mentor group that I was participating in at the time. He was a corporate exec, kind of my avatar. He was getting ready to step aside from the corporate world, was branching into the multifamily. And I said, I want to learn. I don't want to pay the large entry fee at one of these national education groups. So he agreed to let me, I did some work for him, due diligence and other things like that, unit walks and stuff like that, and just trying to get my feet wet. He was very gracious. After we closed, I didn't bug him, but periodically I called him for financial questions and what's happening on this. And so that was my first investment as a passive. And also had a lot of war stories on that one before we finally got out of it too. But great learning lesson.
Right. And it's funny, it's obviously nice to have a smooth operation and have everything go perfectly, but we both know that in the real estate business, you're in the problem solving business. So what were some of the lessons you learned along that way that kind of shaped, your education from there? Because it's kind of the school of hard knocks, as they say. When you get into real estate investment, you can look at any book, you can read this, you can read that, but until you're putting out people's fires and really learning about the weeds of the business, it might not all be what it's cracked up to be. So could you maybe share some of your learning lessons along the way that were maybe a little bit surprising that the typical person wouldn't know?
Yeah, and I think you're absolutely right. There's no such thing as a perfect job, a perfect marriage, a perfect investment, right? They all are businesses that have challenges, and that's what we're paid for, as the general partners, to address those. But the first one was classic. We all get in it because we have the shiny object syndrome of doubling our money in a couple of years, and these were I'll call it more of the golden years a decade ago, when all ships were rising. And I got in this when it was in Port Arthur, Texas. So if any of your listeners know, Port Arthur, Texas it's right on the coast, about 120 miles due east of Houston. And if anybody shows you an opportunity there, run from it. Secondly, this was a building that was purchased abandoned building purchased by a rehab or a developer to rehab the entire 225 units, sat 3 miles off the ocean. He did that. We bought it. It was about 70% occupied when we bought it, and the play was just to lease it up. And then it was followed by, I'll give you the real Reader's Digest version. It was followed by fraud of the property manager, and then it was followed by a flood, and then it was followed by a fire. So we had the perfect storm. I was an LP investor, but the major thing I take away from that is lessons learned is one, be patient, wait. I would say that we did, in all honesty, we refinanced 18 months into it, and I got 60% of my money back, and I thought I was a really smart guy. But at the end of it, due to those fraud, fire, and flood, we broke even. I didn't get any money at all. But what I learned, the major lesson takeaway is know the sponsorship. The guy that was the lead GP, at the end of the day, did everything to maintain the limited partner's wholeness and made sure that after all those trials that we got all of our money back. At the end, we didn't make any money, but we got all of our money back, which could have been a very different outcome. At his own expense, he, I believe, shorted himself to keep the limited partners whole. And so there's a real lesson in integrity that you don't always know until you start doing something. And I'd invest with this guy today because just who he is and his integrity.
Right. That's awesome. So you had basically the triple threat of everything going wrong there, which is kind of crazy, but you still had a good attitude about it. So that's, nuts that you went through that process there. Would you say, moving forward, what were some of the key takeaways of what, you wouldn't want to do moving forward if you work with that sponsor or other sponsors? Like, what are kind of some of the red flags and green flags that you look for when you kind of go through and vet people that present you opportunities? Because naturally, you're known in the space. If you raise money, deals find your inbox seemingly, right? So be curious to know what the green and red flags are for you moving forward to avoid that, potential mistake.
That's a great one because you're right. Like you guys, I'm sure my inbox gets many every week these days, opportunities to invest and people wanting to partner, et cetera. But it's fairly simple. I started out with first know the sponsorship group. I go back to when Lone Star and Vestark started working together. I had seen you guys and we had talked with Rob specifically and heard him speak and talked on several calls, and he even asked me to join an opportunity that I passed on and then subsequently came together to do the next deal, and which is quite successful. So it's understanding the philosophies and really the approach and the depth of the sponsorship. It can be a single person or it can be a team. Doesn't really matter, but that is the most important. It's a triple green flag that you got to have for me. I can see an opportunity from XYZ with a 50% IRR, and I don't even listen to it because I don't know them. So that's the first takeaway. And partnerships, you are in a partnership, whether you're limited or general, you're in a partnership for 3 to 7 years. So as one of my mentors, Rod Khalif, said, partnerships are like a marriage. They're easy to get into, but difficult and expensive to get out of. So make sure, even as a limited partner, that you vet the general partner. And I'm like you, surprised many times at the people that just want to, with all due respect, throw money at me or give me money on a capital raise. After only, and I just really encourage people to get them. So the first green flag is obviously another partnership. I then look at where it's at, the submarket. So, I always say if somebody sends me an opportunity and I'm from Ohio, somebody sends me an opportunity in Toledo, Ohio, thanks, but so I got to know the group. I got to like the market. I focus on the Sun Belt from the Carolinas to Phoenix opportunities today. If I really know the sponsorship group, I would entertain one in one of the Rust Belts or the Snow Belt, but it's got to be really good. So first the group, second the opportunity, and then you get into the mechanics. You want to understand their assumptions in their underwriting. as you and I know, that can really lead to different outcomes. And how I have never heard a general partner say, we underwrite deals very aggressively. Everybody always says we underwrite very conservatively. And one man's conservatism is another man's aggressiveness. So just be careful there. The group, the asset, the assumptions, and then I get into I'm an analytical approach, so I want to know the assumptions in the underwriting, the expense, the income growth assumptions, the reversion cap rates, some of those technical things that have a great impact. And then you want to understand really part of the depth of the team. Who's the property manager specifically? What's their experience? Is this the first time this group's going into XYZ market, or have they been in XYZ market with the same property manager? Because the property managers are really the one that makes or breaks the deal, in my mind. And they're the lowest paid on the food chain by most regards. So red flags for me would be lack of a track record. I won't say it's probably a yellow flag, a newbie, somebody that hasn't done one before. I've helped students before get started and helping them on a deal, but that's probably the caution flag. The red flag is location and the groups, if that makes sense.
It for sure does. And I'd be curious to know, you mentioned property management, and I think you really hit the hammer on the nail there pertaining to it's the least paid, but it is arguably the most important, or if not the most important, aspect to the whole process other than buying well, right? If you can't, buy well, if you overpay, you can't outrun that unless, the market really bails you out. But by and large, what you pay for it and then how the property's managed are going to be the outputs to you getting a good result as an investor, right? So with that said, do you need the sponsor to be vertically integrated for you to want to get behind the opportunity?
No, I don't need for Randy personally. I don't need I think it's a plus. It's back to the flags. It's probably a green flag. It's a good sign if they're vertically integrated because that's really the way they scale. But I think the vertically integrators are the ones that really want to grow and grow big, but there are a lot of boutique groups out there that don't want or can't get to 10,000 doors or 5,000 doors like you guys have. So that's not a red flag for me, no.
Right.
But third-party property management is, yes, you gotta have third-party property management.
Yeah.
If somebody's going to try to do it themselves, forget it.
And I was going to ask about that. So when it comes to third-party property management, what do you look for? Because, for us, it's very streamlined. We honestly, after we, kind of say we're vertically integrated, it's kind of ironic, but there's very few questions that follow that, which almost surprised me now that I'm saying that out loud. They just kind of have inherent trust because you build that up. And naturally, if you've got a track record and social proof, people don't really ask those questions. But if you are a sponsor that's not vertically integrated, how do you get behind them? How do you kind of implement your expertise because you've done this before with, people who are vertically integrated and not, how do you get behind a group that is, not with in-house in that department?
Well, there's a lot of large third-party property management companies that transact across many different geographies. I think that's a plus. I think trying to understand that third-party properties management experience in that submarket. So, with all due respect, you can have a large vertically integrated or a large national third party that doesn't know anything about, I keep picking on Toledo, Ohio. And they've never been in Toledo, Ohio, or don't know anything about it. So you got to find somebody that's got knowledge of that market. That's a must. And then secondly, you want to make sure that they've got a knowledge in the asset class you're in. So if they're doing all class A's and you've got a class C, well, that's a different, in my mind, a different take, and one that's the yellow flag of caution for me if they don't have experience in the market or if they don't have experience in that subclass.
Interesting.
And so that's why you have advantage at Lone Star, because you've got multiple different classes in multiple cities, predominantly in Texas, but I know you're branching out of that. Right. And so it is with other third parties. They can have a national view, and maybe they do or don't have a view in that specific submarket you're looking at.
Right.
But
Right. Interesting. Yeah. Good takes there. And definitely it's nice to know. And I'm always curious to know how people look at that lens of the business as we're trying to, get to have a pulse and a feel for the marketplace. It's super, super crucial and helpful there. So thank you for lending your insights there. So you mentioned a decade ago, you got into the investment space, right, for multifamily, right? When did you start capital raising after you kind of found out about the, wonderful world of multifamily real estate?
well, I did my first LP deal, deal in 2014, just about 10 years ago. I did my first GP and raised capital in 2018. It was a 6.5 million buy in beautiful Beaumont, Texas. Another blue collar Class C property. We had to raise, I think, only $1.5 million, $1.7 million at the time, which seems really low today. And I shocked myself the first time out of the box. I was one of a group, and I raised 600K out of that 1.6 or 1.7 needed. So I was ecstatic with that, and then I kind of felt invigorated. So
Right. So you started there about in 2018. So you've obviously seen a lot of rise up, which is really great. Obviously, things are resetting now, but I'm sure you've gone full cycle enough where you've got that credibility there. But I'd be curious to know, obviously you mentioned multifamily. Is that the only asset class that you raise equity for, or are you looking at other opportunities and other kind of sectors within the commercial space?
for right now, it is the only asset class I'm raising money for. I invest my own money in other classes, but I'm only right now raising in that, contemplating developing a fund in the near future to maybe branch in other asset classes, but that's a discussion for another entire episode. So
Right. Without a doubt. And I'd be curious to know, what are some of the things that, you obviously alluded to, sponsorship on that end, track record and whatnot. But what are some of the other things that you look for when you say yes to a deal that get you excited?
right now, in this current market, I'm looking for something that's different, or something unique. The classic value add or yield play is good, and they're still out there, and I know that they're very capable. But I mean, I love the deal we did last year together in Houston as the tax abatement project, I call it, and that is just. I mean, I told investors, look, I'm not the smartest guy in the room, but if we can take $2 million out of expense day one, this is kind of a no-brainer, and it's that uniqueness. I'm currently doing a build to rent project that I think is unique and positioned for the long term as well. So we'll continue to do traditional value add deals, but for right now, until the equity markets stabilize a little bit, that's what I'm looking for.
I really love that you said that, and I think it's really fascinating. You did say that, obviously talking our own book here, but at Lone Star, we do, some sort of, unique structure, whether it be LIHTC, tax abatement, property tax, opportunities that we eliminate partial or all of them. It, makes all the sense in the world. And I love that because I think, there's not that many opportunities that really come up that are truly deals that make sense to actually implement a value add strategy. What do I mean with that? Well, what I mean is there's been so many deals in the cycle that have been picked over the last, call it 6 years, that there's not, probably since 2018 when the market got really hot after the little mini recession we saw in 2017, 2018. We really saw a very interesting period where basically every deal had traded. So whether it be from 2018 to 2022, these deals were bought, sold, and fixed up already. So you can't put lipstick on lipstick. So I think the brain is so trained to want to do a value add deal. But I think as an investor, you really want to ask yourself, is there truly, is the juice worth the squeeze? Is there actually a math equation where, hey, if I spend $10,000 in a unit, I'm going to get X return, which generates X percent of, terminal value to the property, right? So I really, really like that you hit that number there to think about where, hey, not every deal has that there. And, we're kind of seeing, 1 in every 5 deals that we're buying right now probably actually is a value add opportunity. And what we're seeing right now is tax payment deals, which are, deals we want to buy at market rate, and then you splice that on, then that's, a great deal. If there's deals that we think we're buying at a discount, even better, somewhere where it
Yeah.
shouldn't trade at the cap right there. And then the third option I say is value add, because value add is not necessarily unique to us. I think what's most unique to Lone Star is our tax payment approach. But we're looking for, mid-teens returns any way you slice it. That could be buying well, that could be the abatement strategy, and that could be a value add multifamily play. So, there's multiple ways to get it done. But to your point, until we start seeing, rents kind of, or, a clear sign to the bottoming out, it's might not be the best choice to do value adds. But very curious to see how a lot of these sponsors kind of pivot as, the opportunity and landscapes change.
Yeah, and I think the other one there is, I mean, until that debt market really begins to stabilize more than it has today. And um, the other one there, I was just going to say I had to have a senior moment. The other type of buy that is, I mean, you guys have done very well in the LIHTC and the tax abatement, which is huge in Texas. If your listeners are outside of Texas, it may not be as relevant, but in Texas, they upgrade the taxes, reappraise every year. And so it's very, the sky is the limit. And and the other one I was going to say is the other strategy there is the current market. There's going to be opportunities from lenders with other properties going bust that I think is beginning to play out a little bit now, and will continue to play out more into the future, which will be another buying opportunity.
Without a doubt, the workouts and, pertaining to workouts, the whole industry is seeing this right now, which is, kind of emails going viral from various sponsors basically asking for a capital call or forced liquidation of having to sell. So we're seeing a couple of things right now to your point there, which is, we're recording this a little bit before this can be released, but there was a big treasury run up recently, okay? And when the treasury runs up, it makes deals not really penciled because you want to think you buy here, but then debt comes here. And if that happens, that value dispersion there makes the deal just not really pencil. And sadly, it's very rare that, we saw this obviously happen in 2020 and 2021 where debt was going down, that you had the inverse, you had the other end of the spectrum and that side of it, right? But what we're seeing now is, you have a price here and then debt goes here and it doesn't pencil or make sense. So that's, kind of a whole problem there. Why do I mention that? I mention that because there's a lot of deals right now that people were probably going to buy that are going to come back around to us, or groups that were the second place or third place bidder there that didn't want to, step up to that price, that are going to be the beneficiary of, treasuries going up. And then also there's going to be deals that, don't make sense or pencil anymore that are come to market that maybe you buy from the bank, from workouts, whatnot. So there are going to be a lot of unique opportunities here if you're patient for, outsized returns with, not that high of a risk profile.
Well, and the lenders, you didn't ask me to plug Lone Star, but I mean, the reality is the lenders they have a distressed property. They're going to go to an operator who has the known ability to close. And so they're going to give the ability to a Lone Star or maybe even a Randy versus, the small operator who's out there just getting started, even though he or she may have a great balance sheet. So the historical standing of operators is going to be even more important. They're the ones that are going to get the first looks at these distressed properties from the lenders. I don't think they're going to go through a broker. They're going to go by the lender. And the lenders, just like in the home crisis of years ago, are going to start calling operators and saying, hey, can you cover 1,000 doors or 1,500 doors in Florida, Tennessee, Texas, Arizona?
So
So
well said there, and I couldn't agree with you more. And I'll even go one further there. Not only are the lenders going to call, the Rainey's, the Lone Stars of the world, right? But brokers, number one thing right now, when you talk to them and sellers is what? Certainty of close, which is not necessarily correlated with the highest price, but certainty of close. So if you're a sponsor with a proven track record of doing what you're saying and saying what you're going to do and closing, delivering, raising, and making their life easy through the transaction process, they will shave off, $500,000, $1 million, $2 million, $3 million on the purchase price to have the highest level of certainty of close. That cannot be understated enough in the marketplace today, where, you really need that certainty there, because you don't want to go back to the property, because these are not residential deals where you can close them in 14 to 35 to 40 days. These are 3-month long process is. And you do not want to get to month 2 only to get the call from the sponsor saying they can't raise or this raise is a flop and they need more time to back out, and that, money, maybe it goes to them, but depending on what's going on in the debt market, well, that deal might be worth, materially less, and they're screwed. So certainty of close, time kills all deals, as they say. That is super important. And then I also want to retract back to the tax abatement program and process, not only to there with the big expense, but if you're in Florida, right? Or the Carolinas, or if you're in Houston. Okay, Florida, and I'm sure you're gonna, know where I'm going with this.
Yeah.
Florida is tier 1 insurance risk. Carolinas right now and Georgia, if I'm not mistaken, are also, because they're coastal, are, situations where, insurance is high. Houston insurance is high. So, I think everyone wants to be in these markets for investing, but it makes it very challenging when you've got variable factors. I know for fact in Florida and in Texas, property taxes get reassessed every year. They're big figures, but then insurance is another variable, right? So if we can eliminate one of the biggest items there, which is, property taxes, well, then basically almost any deal makes sense. Now we want to buy good deals and then splice it on, not just buy deals to buy deals, because we have got the opportunity to do some abatements there. But it's something to think about, which is, if you can eliminate that or fix that cost, it's uber crucial. And then you think about insurance and property taxes, it's really tough right now on the insurance spectrum, because everything's getting reassessed. I just look at my car bill, my car insurance bill, and I almost wanted to throw up because it was about double what it was a year ago. I'm looking at my homeowner's insurance quote because I'm buying and selling my next house, and that's almost double for a house I bought for less of a price than my current house, because I'm gonna do another project, Lone Star Capital style value add to it. But it just speaks to the marketplace right now of costs going up and the variables really changing in front of our eyes.
Well, and yeah, 100% all the things you just said. And the only thing I would say is that's also where it's an extremely unfair business we're in, because the big guys get the first looks, they get the better rates. You've got the ability on the insurance side to put all your portfolio together into one policy or policies that the small operator doesn't have. And I don't mean that to disparage small operators, but
No.
it's one of my mentors told me too. It's just a very unfair business. You're going to get a better loan rate from the feds. You're going to get better insurance rates. You're going to get first looks from the brokers and the lenders. But that shouldn't deter people from getting started. That just means manage your expectations and the essential of, I'll say, partnering together like we did. So I hope I brought value to Lone Star. I know Lone Star brought value to me in our deal. And, I'm looking forward to doing a lot more in the future, because together we can do a whole lot better than we can individually.
Well, and I appreciate the ad there for sure. And, one thought that I had actually, and I haven't said this before, is think about Tom Brady. Okay. So not comparing Lone Star Capital to the greatest athlete maybe of all time. Well, maybe I am, maybe I'm not. But my point there is, as the game went on, he was able to physically keep his body to perform well. But what did he have superior to everyone else? It was his mind. It was his ability to see the play before the play happens, know what the coverage was going to be, know where the ball was going to go, and to basically audible out, change course correct before, the play even happened, and then to read the defense, seeing what's going on there, right? So similarly, if you work with a big sponsor in the marketplace, you're going to get preferential insurance numbers. You're going to get, the ability to not have to pay the highest price often to win deals. And you're just going to get economies of scale benefit that just someone who's a rookie, a newbie in the space, is not going to get. But it should be that way to a certain extent. The more you do stuff, the longer you do things for, the better you're going to get at it. So it behooves you, if you're a capital raiser or getting going, or even have ambitions of working with a sponsor in the future, to probably work with a sponsor like Lone Star Capital, or, the various other people out there doing similar stuff to us, because you can't afford to not do raises well when you're starting up your new business with capital raising, because your moat is only as good as the deals that you do. And if you don't pick the right people, you do favors, you kind of say yes to deals that maybe you felt a little fringe on, that's when you get yourself in trouble, because, you are at mercy as to how good the sponsor is. And we're seeing right now, there's a lot of people who might be out of the capital raising business because they chose the wrong horse and the jockey pertaining to, the investments that were made probably in 2021 and 2022.
Yeah, and I'm 100% again in everything you said, and I think it goes back to picking the jockey. And I think I most respect jockeys who have proven the test of time and have shown their loyalties to to their investors and make sure that, because there are so many out there that are transactionally oriented, they're making their money off of act fees and disposition fees and stuff like that. And so, I mentioned the first guy I did deal with, his integrity, and we looked at a deal last year together where you guys stepped away from a large deal in Dallas, and
We paid for it too.
I know you did, and kudos to you. It's hard and painful to do the right thing, but I don't know how investors got to understand that, because there are a lot of people, buyer beware, because there are a lot of people doing deals for the transactional fees because they've got a large, forgive me, because many of them are vertically integrated and they got to keep the transactions alive to fund the back house. I can think of two other ones that are just, in my mind, doing a lot of deals versus doing quality deals and keeping their investors whole. So kudos to what you guys did there on that one too. I feel like a commercial here, but it really wasn't planned that way. You didn't ask me to. So
Right. I did not hold any gun to your head or hold any family member hostage to get these kind words, but the feeling is mutual with the value exchange, and really grateful for that. And to your point, the way we look at the world is we only eat on deals that basically hit, minimum a 10% return. And even if we did a deal that's a 12% IRR, it's great from investment, but we didn't do that well. So we really want to have outsized returns in the deals that we do. And, even with more of that said, every deal we do as a new sponsor, and I think there's a lot of value to working with, because we're still relatively new in the scheme of things, right? There's sponsors that have got, 20,000 plus stores, right? We're not those people. But what's really important to think about is, and this should give people reassurance, is that we are still what would be considered a emerging sponsor. If you're kind of in the, syndication space, you're kind of getting into it. You've probably, I would like to think you've heard of who we are. It's our name along with a couple others you kind of hear kind of consistently, is what the feedback I've gotten from our capital partners and people that reach out to us, is that our name's thrown in there with a lot of the other household names for sure in the space, which is very flattering. But we're still, we only exited 2 deals. So every single deal that we do right now, we want to make sure that our net average IRR to the investor is really high to make sure those numbers look good. Because even at 30 right now, that will obviously weigh down as we do more exits, naturally, because 30% returns are not sustainable naturally. But with that said, every exit and every deal that we do needs to be as close to flawless as possible on the front end, because if it's not, then how are we going to make the numbers work on the back end? It's not fair to assume that, the capital market's going to be like 2021 where everything is going gangbusters. So every deal we feel like we're on trial, and also just on a personal level, I invest in every single deal. So, selfishly, I want to make sure that I have the full conviction and confidence where I call Rainey, say, hey, we've got a great deal and I'm investing X amount of dollars in this. Well, I'm putting my money where my mouth is. It's not just, oh, well, I'm taking this acquisition bonus and going on vacation or spending it on something silly. This is truly for our deals and to grow my net worth and to grow our relationship together. And, I mean, you've met us so many times, right? We've been together, but, I have to respond to you, and I have a relationship that I'm trying to upkeep here. And if we start doing, subpar deals, and maybe for the moment it'll be fine, but 5 years from now, you're going to look at me funny, and I deserve that funny look because I have to respond to it at some point.
Yeah, you hit on a couple of great things there. One, I was gonna say also, we talked about bigger is better sometimes in terms of the deals, in terms of first looks and stuff like that. But also you hit on the keyword. It's not only it's not only an unfair space, but it's also a very, very takes a team of people to be successful. Wherever you're at in a space, whether you're starting or even you guys got multiple partners, I've got partners. It is truly a team sport. And for people to understand the dynamics of that team that they're joining as an LP or as a GP, I mean, you hit another big red flag there that I failed to mention earlier. Does the sponsorship group have money in the deal themselves? And, is it, and I always ask the follow-up question, is it your out-of-pocket money, or is it you just rolling in your AC fee, your acquisition fee? Because a lot of people do that and they really don't have any out-of-pocket money in it. Like you, I proudly put my money behind my mouth whenever I'm doing a deal as a sponsor, to make sure that I've got my own money in there, and we're equally incentivized with all the investors along the way. And that's really important.
Yeah. So you mentioned that you're looking for unique deals right now, right? An abatement,
Yeah.
something that's probably outside of the norm, which is very smart right now as we're kind of in a weird, turbulent time. But what are some of the key metrics that get you excited for doing a deal? What kind of, gives you pause and what kind of gets you excited if you were to get a deal on your lap right now to make you feel comfortable to transact? I mean, outside of story, of course, but just from like a numerical perspective, is there any sort of ratio that you're looking for on certain things? What gets you excited?
Well, I think first and most important thing is excited to work with groups, new team members. As we said, be it Lone Star or the group I'm working with now in Dallas on a BTR is a group that we've, again, I'll say danced together for several years. We're finally wedded and we're doing a deal together, and I'm excited about that one. Number wise, I mean, I think I would rather be conservative and tell investors they're only going to get a 1.7 or a 1.89 equity multiplier, whatever it is, versus a 2.0. And I'd rather continue to be conservative and tell the story, but that your money is safe because this isn't the traditional asset in XYZ, wherever that is. And the sponsorship group has proven track record, et cetera. But I guess I wouldn't look at it if it was like you. I say it's got to be about a 14, 15 IRR at a minimum, with a projected hold 5 years. I don't think anybody wants to look at a deal that's projected to hold 8 or 10 years. Some of the opportunity zone projects that are 10-year deals, I'm not really interested in. Maybe for somebody, but not me. But it's still that higher than expected return that you're going to get from the stock market, And so I still have some money in the stock market, but majority of my assets are all in various multifamily projects across the U.S.
Yeah, it's so funny. I must be the one of the only people in this country, or maybe very few, I guess, outside of the space, but I talk to my friends and I'm not the most liquid person because all my deal, basically all my equity is tied up into real estate stuff where I really can't pull liquidity from them for the better or worse. So, I like that. And to your point, a 4-year, 5-year hold period is fine with me. But when we get to 7 to 10, that kind of makes it more challenging. Not that I would be okay with not, but just on the front end, projecting that does kind of draw a little bit of pause for me to get fully comfortable and behind that because,
Yeah.
who's to say it makes sense. And the world just changes very quickly now, now more than ever before, things just ebb and flow at a different clip. And who's to say in 4 years from now, or, the 4 to 8 year horizon, well, in 8 years, there could be totally different laws, rules, and regulations that materially change and impact the deal. But in 4 years from now, it might be slower moving, or that might not be there, right? So, that's all to say that you wouldn't know. Maybe, at that year 4, year 5 mark, you get burnt a bit from, legislation change, but you just want to be recycling and kind of moving money around as much as possible at a reasonable clip to that point there for sure.
No, I was just going to say, but the fundamental in all that though is that people still need a place to live, and that's what I keep banking on. And the national numbers, I've heard anywhere from 3 million to 8 million unit shortage across the U.S. And that there's just no dynamic that's going to change at any time in the near term. So makes this asset class different in my mind than all the other ones.
Well, and I think we're actually missing a big item here. And this is not a political comment. This is just a comment. Okay. So it doesn't matter what side you're on in the aisle, but as it's been well documented, there's a lot of people coming from south of the border into the country. They're not going to live in tents. They're going to have to live somewhere. But my guess is not going to be living in A-class property. They're not going to be living in the Ritz-Carltons. They're probably living in workforce housing, stuff that we kind of buy, which is, renter by necessity, which you can't replace for, a cost-effective price. So this just goes to the moat on supply that we have in the kind of workforce multifamily space, specifically in, states like Arizona, New Mexico, likely Texas, Florida. These are places that are, a little more Latinx friendly, where culturally there's a lot of fit there. There is a big case to be made that, the numbers that they've sent are underreported. So not only do we have the 3 million, as you mentioned, housing shortage for properties there, but now you have to think about the immigration going on to this country as well. That will also keep, supply, demand metrics at bay and be, quality for the fundamentals that we're seeking in the properties that we're buying.
Yeah. Um, 100% again, can't disagree. And it's probably going to occur in the coastal cities, the West, the South, and the East along the coastal cities that we've seen all those Californias, the Texas, the Floridas, the New Yorks, and where those migrations are being bused to. Uh, Again, no political comment, just factual.
Yeah.
So
Nonpartisan, as always, of course, but it's not really whether you and I can fix it. It's how we can figure out a way to make a buck on it, which is kind of my philosophy and strategy there. I
there
one
you go.
guy can't do anything about it, but I can, put my dollars to use where I might, be in benefited most receipt, or be, put my dollars where I can receive the best benefit for, I should say. With that said, you also mentioned before getting on the show that you were working on a really fun kind of mentorship program and process. So I'd love for you to deep dive
Yeah.
that a bit. Give yourself a free ad, the shameless plug here as to what's going on pertaining to that. I would love to learn more.
Well, thanks. And it's at that season of life where I've been doing this for 10 years now, and you kind of like what's next. And so a partner and I really decided, well, two, we want to give back and want to give back to the space. And when I got started, I was in a couple of large national, educational groups. And they per se charge you an arm and a leg to get to pay for entrance or pay to play arena where you pay a large amount of money, 25 to 30K. Not disparaging any of those groups, but that's what I call the big box syndrome. And we're trying to create a really boutique personal shop, more like the True Value Hardware versus where, I walked into one recently and somebody said, "What can I help you with, sir?" Well, you don't find that at the big box Home Depot. So we want to provide a very personalized approach and help people get started at a much more affordable entry fee still. For your audience, Craig, if there's anybody interested, if they reach out to me and tell me they heard me here, really what we're offering is the entire course is 12 modules online with weekly group calls and mentoring, and then email access as well. And so what we're offering for a 30-day trial is only $197. Anybody that contacts me can get out there and gain access to the first 3 modules and join our group calls to see if they like it and if it's any value to them. So
That's awesome. Well, and so we just love to learn a little bit more to deep dive on that. You obviously, and we were kind of just laughing about, the big names, which is they're great. It's, there's no right or wrong, just what is good for you.
yeah.
So the ins and outs of these groups. What would you say is a little bit more different and unique about what you've created compared to just the typical, as you said, the big box kind of, one size fits all, mastermind course kind of setup?
Well, when I joined those groups, and I've been in 3 large different national groups, all good, not disparaging any of them. I have nothing bad to say about them. Just one, they're so big today. They're so impersonal. They're very expensive to get started, as I said. And I think that when you contact myself and my partner, you're going to get us as coaches, not one of the underlings from the superstar, I'll call it. That's in one of those large national groups. You're going to get us and our experiences. He's got as much, if not more, than I do. Those are the major differentiators, and our price point is just much lower. We're not going to build a educational empire off this, as some of the big boxes have. And I'm not, again, they've been very good to me, but many people don't work well in those large audiences. They need some more hand holding.
Yeah, and I think there's different strokes for different folks. Like, I think those things are great to have a community, to feel like you're not alone, to be a part of something there, right? But then you have to think about, the other side, which is okay, well, now you're in the weeds of it. Are your questions going to get answered outside of just posting on a Slack channel, as opposed to working with someone who's, seen fires, floods, and theft seemingly on the property side. So you've gone through this, song and dance before. So to kind of expedite your learning curve with some one-on-one coaching and mentorship would be really valuable. So I encourage everyone to reach out to Randy. He knows so many people in the space. And also, on your end, I'm sure you've basically talked with and/or have had a conversation or researched probably every operator sponsor in the business. So you kind of have the T, as they would say, on many of the groups there. So to expedite your learning curve, I really recommend you guys to work with Randy. Personally, just give you a plug here, as you so graciously plug Lone Star. Randy's just a pleasure to work with. He's knowledgeable. He's on it. He's a gentleman. He's a man of his word. So if you are looking to get into the space, I would really would invite you to reach out to Randy and have a conversation if you're looking to learn a bit more. So happy to give you that plug there. And thank you for sharing that and information, and congratulations on creating that, module and course and mentorship group.
Yeah. Well, hey, it's my pleasure. And I think that's the reason that back to the teamwork, my Lone Star and InvestArc have worked together is because there's a ton of mutual respect going back and forth. And really appreciate the opportunity to be on your show today, Craig.
Yeah. So with that said, final wrap-up questions we've got here. Curious to know, what assets do you think are going to be doing best? It could be anything. You could go any direction here, but it could be multifamily. It could be, Bitcoin, whatever you think will do well. You're coming up, but I'd be curious to know if you have any take on what you think will do best coming up, considering, where we're at in the marketplace. And I'm just going to preface this. This is recorded in May. So if a Black Swan event happens between now and the event of recording, no gun to head. Don't say we didn't warn you.
Well, I would say historically, if you look at the downturn of 08 and 09, the Great Recession, I would say that historically, the best performing assets in a down market, debatable if we're in a down market or not, are mobile home parks, self-storage, then multifamily. And multifamily only did a dip in 08 and 09. I'm told like 3%, something like that. So for pure safety, though, those aren't, in my mind, those other asset classes, mobile home parks and self-storage, aren't essentials like multifamily is for the general public. So I still am heavily invested, majority of my assets in multifamily. People ask, when's the best time to buy? And I say 20 years ago or today. You just buy very differently today than you did even 12 months ago. And so that's my short view.
Yeah, without a doubt. Yeah, no, and I agree. And this goes to the concept of this: luxury or necessity. What is a luxury? Going to an office. Okay. Self-storage, you could argue, is a luxury, right? To your point there. Airbnb, luxury. What is a necessity? A roof over your head, a place to live, and getting your, costs as fixed and as affordable as possible. Well, that's exactly why we're in the apartment business, because that is where most of the nation live, is in apartments, right? Or built to rent communities, as you alluded to, which is basically, mirror matching, similar kind of background, right? So I appreciate the insight there. On the flip side, and this could be a little self-explanatory, but what do you think, on the same coin, will not do so well coming up here with the looming recession?
Stocks and bonds. And everything runs in a cycle. In my mind, everything is connected today. If there is a event in the Soviet Union or Israel or China, everything's going to be affected. I still think that stocks and bonds will be hit heavier than multifamily, would be my take. And that's my greatest risk today, is a world event that nobody has control over, like COVID. And the most obvious one to me is a third world war that is on the potential horizon.
Yeah. Well, and it's kind of interesting. And this is kind of the beautiful thing about, I guess, real estate assets, just generally speaking. To your point there, stocks and bonds, stocks specifically, there's a ticker. There's a fluid price every single day. And any moment, like we saw in the GFC, albeit this is a, anomaly black swan event, but basically, if you had $1 in the stock market, it got cut in half, right? So you don't have a stock ticker on your apartment complex or your home every single day, which is nice. It takes a lot of the emotion out of it, because people, kind of like to check that maybe a little bit too much. And they don't see the bigger picture. And there's also a little bit more human touching we can do on our end to kind of manufacture returns, as opposed to stocks, bonds. It's a little bit out of your realm. The president could say something, salacious, or, get political, and next thing you know, the stock could get cut, which is, outside of anyone's control here in this conversation, right? But what is in our control is buying well, implementing a good business plan, and executing, right? That is more in our control than the latter, of course. So with that said, what is getting you most excited about what's to come up here, right? So, I'm excited because, just to answer the question first, then I'll turn it back to you. But I'm excited for a lot of the sponsors who probably shouldn't have been sponsors, kind of leading the space. So, selfishly, I'm looking forward to seeing some people kind of get cut out of the business. I don't want anyone to lose money, but it would be nice if there was less people there
Yeah.
in this space to help us buy more wealth. That's very wishful and selfish thinking. But at least I admit it here, and I will admit that I'm a little bit selfish in that regard. So that's what I'm excited for. But what are you excited about for what's to come?
Well, and I think the culling of the herd is certainly imminent if it hasn't begun already, to echo your point. What I'm most excited about is I just see the horizon as bright. I'm an optimist by nature, but I'm even more of an optimist on this space because, the other one is you talk about if you weather 24 and 25, they talk about the shortage of building and there's going to be low supply. And so that's going to force, believe it or not, rents up in 26 even more than what they are now. And so it's a great time. It's a great time to buy, positioning yourself for that 26 through 30 hold period to make money. So I live in Texas. All I got to do is drive around and see the enormous amount of development work in multifamily. And I had a investor here recently, and he's from Ohio, and took him around driving some of the stuff, and I can witness it firsthand. And you've seen it in Phoenix area too, just the tremendous growth that is crazy. And it's all happening in the Sun Belt. So
Yeah, it's awesome. So final thought for you. I like to usually end it. Do you have any hot takes or contrarian takes that are maybe you hold that the average person wouldn't have per se, or something that's a little bit against the grain that most people don't think that you believe, kind of a hot take, if you will?
wow, that's a question I've never been asked. A hot take or contrarian view. Um, I would say and I don't know if that's a hot take or contrarian view, but I'm optimistic, but I'm a professional skeptic and all deals flows and trying to understand it. And so I'm an analytical type. That's my bias, good or bad. And I scrutinize deals I think very good and very heavily, that a lot of people don't do and more people should do. And because they just don't want to take the time for it. But if I had the contrarian view, it's that I say no probably 10 times more than I ever say yes.
As you should. I love that. Well, Randy, you've been such a great guest today. Where can the people find you if they reach out, they want to learn more about kind of your pipeline for what you're raising for? I know you mentioned the BTR
Yeah.
community, kind of learn more about you, get into your ecosystem, learn more about your coaching, mastermind mentorship program. How can people get out, reach out to you, and get into your ecosystem?
Well, I appreciate that so much, Craig. It has been a blast catching up with you. Two ways. So I'll make sure your people get it for the show notes, but the corporate webpage is invest-ark.com. There's a contact me now page there that I'd love to chat with your audience. And second one about the coaching side is Multifamily Maestros, all one word, multifamilymaestros.com. There's a discover call out there too, and I'd love to chat with anybody. And it's been great catching up.
Absolutely. Well, Randy, thank you so much for coming on the show, dropping your knowledge as always, and for being a partner to Lone Star Capital and friend as well. We really appreciate you being here today. For the listeners, audience who tuned in for this episode, we appreciate it, and we'll see you next week. Peace.